Hey, hello, and good morning. Welcome, everyone, to our Sunday business chat. Well, I'm Greg Piskazov, an organized entrepreneur who thrives under pressure, with a solid background in electrical contracting and a passion for property investing. I found a unique intersection where these two worlds meet. Each week, we will dive into the nuances of building and scaling businesses, sharing insights and practical tips. And that can help you succeed. Whether you're managing complexities of your project or navigating the property market, this space is for you. So let's explore these exciting opportunities together and make the most of every Sunday morning. Stay tuned. And today we are diving into the essential of bridging finance. Well, from understanding the costs involved in making a careful selection for your investment and knowing what to do if you default or are close to. We got you covered. So stay tuned as we explore how to make smarter financial decisions to elevate your investment game. So I hope your morning started as exciting as mine. And with such a big subject today to cover, it's a no small task, but I'll tell you my story. So, autumn last year, we faced a decision between choosing a bridging finance with a higher interest rates or with a higher product fee. And this is what many investors these days, are facing between both options. And that's exactly what I want to cover in today's business chat. So we will have also a problem of choosing a wrong finance, options as these happen as well. So for less experienced people, might the decisions when they made of going for a bridging finance, they might not take into considerations all of the fees that are associated with it, and that will put them into a very difficult position when purchasing the actual property or the exit of that property from bridging finance. That's also very important. And defaulting on your finance, which did happen to us. So stay tuned as I'm going to share exactly how did we came out from it and how much did we actually pay. So higher interest rates or higher product fees. There's a lot of internet content out there. So listen to what I've got to share with you today. Higher interest rates. So bridging loans, they offer a higher interest rates, rather than traditional loans due to their short-term nature and higher risk. So, for example, loan rates could range from 0.89 percent per month to a 1% a month and higher in some cases. But this will depend on your credit profile, the loan amount, your experience, and the project GDV value. GDV is a gross development value. The pros about this is the lower initial fees, making the upfront cost more manageable. This could be beneficial if you plan to repay loan quickly and minimize the interest occurred. So this is if you're going into a property and, for example, want to flip it, and you only need about 4 or 5 months and less, then perhaps you might opt for that option for lower initial cost, but the higher rate. As you know, you will be in and out very quickly. But higher product fee. So there's no wrong option. You just need to make sure which one you want to, which one matches your criteria for your project, for your financing, so you know which one is better to maximize on your return. Higher product fee. Product fees for bridging finance can be, substantial, and we paid 3% last year, so quite a lot. And as you know now, so we've actually opted for a higher product fee on this occasion. And the higher product fee is it's a fixed one-time cost to set up this loan, which could be easier to manage if you have if you have the cash on hand, lower monthly payments compared to a higher interest rate loans. And what's not so positive about that is the higher initial cost is requiring you to put a significant amount of money before you actually start the project. So you need to have more money in your pocket to actually start and purchase the property. As the bridging finance, they lend you typically 75% loan to value on the purchase price, but maximum up to 60 to 65% on your GDV, on your gross development value. So if your gross development value 60 to 65% is less or equal to your to 75% of the purchase price, they obviously won't lend you that. So you need to know what you're doing, and if you're developing property, you definitely need to understand all of your costs and the exit strategy. But we're going to come to that. So cost effectiveness, of both options. So decision between a higher interest rates and a higher product fee. Well, depending largely on the duration of that loan, the cash flow situation. So how much money you have, in your pockets, or maybe how much money you have on a monthly basis. As a respect, because you might opt in for a lower initial fee, higher interest, and this could be serviced by all of the other income from your assets, which could in turn be even more beneficial for you. And the timeline, obviously, for your project. So stay tuned for more. If you expect the longer period, then the product fee upfront, lower interest rate can save you money in the long run. But let's talk about the key facts of these loans. So the loan purpose and duration, as I said, usually bridge finance is up to 12 months, and it depends between buying a new. So as a bridge finance is between bridging the gap between buying a new property and refinancing or selling onto the long-term mortgage. So the long-term mortgage will not allow you to buy the property and do a little bit of work to bring the value of that property up and then sell it. You will be paying a lots of like the fees when you break that 20, 30-year contract. And the bridging finance comes in and fill that gap. So fill the gap for you to purchase, secure the property, do all the work that you have to do, and then you can use the high street lenders to refinance, or if you choose to sell the property so you can repay your bridging loan. The loan to value ratio, which I mentioned just before, is typically 75% of the purchasing price. So if you're buying a property for 300,000, they will lend you 75% loan to value of that purchase price. But be careful, that's not always the case. They will need to consider the gross development value of your project. And this is not up to you. This is up to QS, a valuer, which you will pay for, and the bank is going to send someone to find out and analyze the market and prepare a report for you and actually for your lender. So in their eyes, they believe that this property will be valued at such and such. And from that point, the valuer will be like, okay, we're happy and confident to lend you that money, or we not. And repayment terms. So the loans are typically, interest only, and meaning you will only pay the interest, and then you will pay the capital at the end of that term. And that's how important it is to understand your exit strategy. You need to know exactly what this is, and you need to demonstrate to your lender that you know what options you have to repay them. Otherwise, they won't lend you. So the crisis that happened in 2008, the people self-certified their mortgages and affordability, and the banks never actually verify if they could pay those mortgages. So many people have defaulted. Banks end up with lots of properties. The values of these properties were worth not as much as the loans on them, and that's how we had a market crisis in a very short, broad terms. So let's talk about the fees that you have to consider when opting for a bridging finance, as these pile up very quickly. And if you not considering all of the fees, I would strongly recommend to use a calculators. What we have, we've got various Excel spreadsheets, and we are using an online tools to help us analyze these deals quickly to make sure that you're not going to make that mistake and saving you money and saving you a lot of headache. I've spoken recently to a few people who have fallen into that trap of not analyzing all of the deals, and they now have to pay thousands of money as they defaulted on their product, and unfortunately, it's costing there not only money but the stress, and putting the family and themselves through all of that unnecessary journey. It's not needed. So listen to what I've got to say. The important fees. Number one, arrangement fee. It's a product fee that these are charged by the lender for setting up the loan, and it typically is from 1% to 3%. We did seen a higher arrangement fees, but usually is about 3%. But be careful. Make sure you understand when you get the breakdown from your finance advisor, or if you use a broker, or if you speak directly to the lender. Make sure you understand all of the fees. Ask for a detailed breakdown, which you should receive anyway. Make sure you ask them how they've come up to those figures, and challenge them. Can you ask them, how did you calculate all of those? Because you will see that actually the way they do come up to all of the calculations, like a rolled up interest, I'll come to that, it's more complicated than it looks on the paper. So arrangement fee, typically 1 to 3%, 4% maybe. Number one. Number two, it's your broker fee or admin fee. On different lender, different broker will break this down in a different way. Sometimes they put an admin fee, so it is actually for them to put the application for you. It could be application fee as well. And this is where your broker is just securing the finance for you. You'll be expected to pay them maybe a little bit, but they get even more from the lender for arranging these finance for you. The next fee, which you will be expected to pay, it will be a valuation. So this is what I previously said. The lender will send out a valuer to inspect your property, to check the local market, find out the local yields for the rentals, and find out the yields the property commercial ones and residential, depending on your project. Based on that data, they will compile a very detailed report, which will be sent to your lender, and you will receive a copy as well to understand. So it is absolutely crucial that you know how to calculate the GDV of your project before you choose any finance. And also, it is very important to work with your bridging lender or with your broker, so they can tell you which finance is the best for your project, as well as understanding how each bridging lender works out their valuation for the property. So it could be some of the lenders, they or some of the QSs actually, they use something known as a bedroom value. So they will analyze the market, they will analyze your area, and they will say, oh, typically, so if you're converting for HMOs, typically in this area, the value of one bedroom with ensuite property is about 100 to 115,000 per bedroom. So if you got 6-bedroom HMO, which is C4 class use, then you can expect a GDV value of 600 to 650,000. But if you are in a less demanding area, that value might drop significantly to about 85 to 90,000 per bedroom, and that drops down your GDV, which drops down your availability for your funding from your bridging finance, and also it could mess up your exit and whether you will have enough money to pay the bridging loan in the first place, or you will have enough money to pay your investors if you're using other people's money. And this is key. So you need to understand how to calculate before you go into that project. But taking the next very, very important is it's the legal fees. So you will be also expected to pay for the lender's solicitor, and this is super crucial. Before you go and accept the offer, before you go and hit accept on that finance, you need to understand how much they will charge you for the legal fees, the lender, so you can put this into your calculations, because this is not a small amount. This could be up to £2,000 to £4,000 for the lawyers. So solicitors of your lender, they need to go through all of your documents, all of the legalities of that purchase. They need to talk to your solicitors as well. And regardless whether you will proceed and purchase the property, or whether at that point you find difficulties in proceeding, that money is, you're liable for that money. So whether you go for it or whether you close it or not, the deal, you're going to have to pay this as soon as you engage with a bridging lender. So be very careful. Make sure this is in your calculations, so you're not going to be out of your pocket. As you can see, this quickly adds up. Arrangement fee, broker admin fee, valuation fee, legal fees. That's not the end of it. Exit fee. So although you're paying all of it, and that also is the key. So the exit fees could be, it's just usually a fixed amount, a flat fee, or a percentage of your loan, and is about 1%, 1.5%, 2%. But as I'm saying, these adds up very quickly, and sometimes it's not shown on your deal. You can get a very detailed brief from your lender, or you can get a very like a short executive summary of your bridging offer, which may not have clearly explained your exit fee. So make sure you ask about your exit fee, as you will be expected to pay that on the end of your refinancing. So when you come off your bridge to the new lender. So exit fees could pile up very, very quickly. Be aware of them. And the most important is the interest payment. So you can pay them monthly, or you can pay them rolled up. So these will be added to your amount, to your loan balance, and taken away from your facility that you're going to get on the day one. And that's super important. The day one loan value and day one net loan value. So this is how much money you're going to get. And then make sure that you are paying attention to the net value of day one, because this is the actual amount of money you're going to get from your lender that they are going to give you. So in this occasion, we bought a property last year for 292,000, and we used a higher product fee with a lower monthly interests, and they've rolled up all of our interests and taken it away from the, from the 25, from that 75% they were lending us. That means that they only gave us 219,000, and we had to make sure we can put the rest of that money to buy the property, and also stamp duty and your lawyers, your solicitors, everything else, all of that needs to also include in that money that you're going to put in. Whether you putting in or whether you're using other people's money, that's exactly where you have to pay attention and analyze it very, very carefully. On this occasion, we put it in, and we've opted for higher product fee and added to the loan, rolled up interest. So we had enough money to purchase the property, and we also went for a development finance in our situation. So if you are using bridging lender to bridge the gap for you to purchase the property, make sure you have all of those fees I just mentioned. So arrangement fee, broker, valuation, legal, exit, interest payments, plus your side of all of your payments as well. And you can also use on your development. They'll give you 100% of the cost of works to do your property. So if you, in our case, we needed £125,000 to convert this 3-bedroom bungalow into a 6-bedroom luxury HMO with en suites. And £125,000, they give us a whole 100% of that, because they want you to succeed in your in your investment, in your development. So they give you all of that money. But that doesn't come free, of course, and you have to take into account stage payments. So development finance works in a way that, firstly, you have to fork out, let's say, for example, 20 to 30,000 pounds to start the works, and they give you the finance in arrears. You go in, create the value. You have to get the QS to come, usually from the lender, to come audit your work, your site, and on that basis, they'll create the report to confirm, yes, you've created that amount of money, and that money, that report is ending up on your lender's desk, and they release that payment back to you. So staged payments on your development finance, and each time that person comes to audit, that QS comes to audit your project, be very careful, because these payments pile up very quickly, and that's what's not on your on your executive summary breakdown from your lender. So make sure you ask your broker, how much will cost me to get my staged payments of of the development finance. And in our case, this was 599 each time. So you want to be a very structured about how you're going to use that facility. So maybe it's easier if you have more money in your pocket, so you will have to use less of that facility to draw down. So if you stage 3 payments, that will cost you 1,600 and more. But the more stages, the more payments you will have to make to the QS who comes and need to audit your property. So be careful, account for them, because as you can see, the money starts piling up very quickly in thousands. On the end of your bridging finance, and actually on your development, on the stage payments, you will be expected to produce every possible document confirming compliance of your development to get the last payment from your development finance to cover your costs. And this is crucial. You have to be very organized about that, because if you fail to recognize how long it will take to obtain all the certificates and actually confirmation of compliance that your furniture are fire resistant. So some of the crazy documents that you have to produce. This is what cost us £7,500 in defaulting for 1 month. So this is our biggest learning from last year. We have been asked by our bridging finance a list of documents which we had. We know the standards, gas safety, electrical certificates, all the compliance, building regulation sign off. So all the usual. That's, we've had this all sorted. Everything was, up to date, ready, delivered. We are in process, expecting refinance in the next few weeks, and we had 6 weeks to do that. So you would say, okay, maybe that's not a lot of not a lot of time, but we were finished everything. And from that point, we were asked for, we've been asked for a fire risk assessment. We've also been asked for a few documents that we've not been told at the very beginning that we will need to supply them. Okay, well, if we do, then that's fine. And this is what costs us time, and that time cost us a lot of money. So we've produced the documents, and as you know, I've got my electrical company, which is a separate legal entity to my property business. So I've went and I carry out the fire risk assessment on my property, and the lender turned back and said, "Oh no, that's not. We can have the actual buyer being on the certificate, doing their own assessment." And it took us about 10 days to go back and forth with the lender. And I've told them, like, guys, that company is a completely separate legal entity. We confirm the fire risk assessment based on our experience. We go to people's homes and put a fire prevention system in their homes, making their homes safe. So how can I not do an assessment on that property as a separate company? So, and I did ask the question, is this being designed in a way for us to fail and actually fall into a default? So we'll pay you more money. And it was just a very blunt and direct message that I sent to to solicitors, legals, their legals, the bridging lender through my broker. And listen, what happened? We actually engaged with someone to go and with a third-party company to audit the property. But on that, after we engage with someone, pay them, we got our bridging lender come back and tell us it's fine. Actually, we'll accept your risk assessment. But that delayed our completion agreement, agreed date. So after speaking to my solicitor, he told me that we can't agree the completion date until we have everything signed off. And listen, guys, we were 1 week short from the end of our breach, and we paid £7,500 for that for that 1 week, essentially defaulting for 1 month. And that was cheaper than extending the loan, which this is again is understanding your numbers and what you do. Because if I was to get an extension, it would cost me a little bit more the first month, but it would cost me less if I need to extend for another 4 or 5 months. But I had everything. And all we had to do is them lawyers saying, okay, agreed a new day of completion. And that was it. And that's exactly what cost us. And I want to share this with you so you won't make my mistake and you save yourself a lot of money. And other considerations that you have to take when you're choosing a bridge finance is it's your profile, it's your credit score and financial profile, your experience. So if you are experienced landlord, if you are experienced investor, you will get a better rates, or you will get the standard rates. The more experience you have, the lenders will take this into account, and essentially it will be a lower risk for them because your portfolio is quite vast, is extensive, and you've got a proven track record that you go in and you create value, you're refinancing or selling the properties, and you're just going to make them and yourself a money. But if you're a first-time investor, first-time landlord, and you go in for a bridge finance, they're going to assess that risk as a high and give you quite high interest rates on your offer. So on these occasions, it's actually really good to do your first deal with someone, JV with someone, and actually leverage their experience to get a better deal on your loan. And if you're on your next one, then you obviously have that experience of doing yours, which you can prove that you've done to your lender. So that's a great tip there for you. Take this. Exit strategy. So having clear and defined exit strategy, whether you're selling the property, whether you're refinancing, or there is another method like a long-term lease, lender will want you to see a viable plan for how you intend to repay them, basically. Risk management. Understanding the risk involved, including the potential higher costs in the long terms. That's where we've understood the risk. Going into a default, it's not an easy decision, but extending, you need to understand all of the costs and manage that risk. So experience comes in very handy. And if you are an experience, there is a lot of networking events around you. I'm absolutely sure there's a 52-pin meetings in the whole country, developers network, partners in property. There's just so many of them. Make sure you rock up to one of those meetings and ask all the questions. And if you're unsure who to ask, just go, walk up to the host, and they will be more than happy to point you in the right directions. I know 5 different meetings, and all of these hosts of these meetings are absolutely amazing, and they will make sure that you will be as much successful in your property journey as only possible. And well, when you calculate all of these fees, everything, there's just a few more tips I want to give you that you will take into consideration. So remember to account for your VAT on your, on your refurbishment, on your development. This is very, very often being missed by even experienced people when they are doing another project, because it is very easy to get distracted by business, by life, and but if you got a calculator, maybe you can train someone to do this for you, and they can just crunch the numbers nice and easy. So remember to put a VAT on your refurbishment. If it's refurbishment for HMO, is 5%. Remember to put a contingency on contingency on your refurbishment and your build. It is I don't think we've done a project before where we haven't accounted for the contingency and did not have to use it. So there's always unforeseeable, tasks, problems, challenges, buildings, movements in your property, cracks. As you are going into a property and you're doing a heavy refurbishment, the things just happen, not to you, but actually, well, for you. Because imagine if you see a problem, you want to fix it. You don't want to patch it up and hope for the best, because you're about to put people in, to live in that property. Whether you're renting or selling, you do want to do properties properly, and that's the only way to do them, because someone else's life is at stake here. So having a contingency on your plans, definitely a must-have. And this is more than many times been overlooked, is holding fees. So it's not good only to calculate how much it will cost you to refurbish, how much it will cost you to, to develop the property, the finance, the legals, the bridge, the exit fees, all of those, if you're not taking into account the holding fees. So this is This is your council tax, your water, your gas and electrics, depending which time of the year you're doing your projects. You might use more electricity. Through the winter time, you will use more lights because it's going to be dark in your property, and maybe you'll have to put more heating in, such as commercial dehumidifiers to help with the moisture when it's plastering, or heating, to heat the property. So if when you put your furniture, they won't get damp. And this could cost you much more than same project done in the summer. So taking that into consideration, super important. Make sure you take some notes or review this recording. And on a lot of occasions, we face challenges with just managing the project and running different businesses, being busy, a mom or dad, looking after kids, looking after maybe your work. Maybe this is what you do in the part-time, and asking yourself a question: do I have time to manage this project, or do I need to get someone to manage it for me? What's the benefits of managed project or a self-managed project? And I think this is a good question for maybe a next episode I've got to do, and I've got a few people who could help me answer that question. But in general, a good project manager will save you money and time and stress and hundreds of other things. So definitely worth looking into it. I've got some questions. Sorry, I've not looked at them. Hello, good morning, guys. Clement, good morning to you, buddy. And yes, are there any specific people who can help calculate GDV? Yes, my friend. Yes, definitely. There are lots of people who can help you calculate your GDV. There's a lots of help out there, on the internet, and this is number one key factor before you go and speak to your your bridging lenders, your brokers. The first question they will ask you: how much you're paying, what's the GDV? And so you know how much you're going to pay. But GDV, there's a lot of materials out there, but as much as there's a lots of information on the internet, some of them might not be accurate for the lender you are going to use. So your broker will ask you what's the purchase price, what's the GDV, but what you want to ask him first: this is the property I'm thinking of buying. Which lender could be the best for me, and what is their assessment to do a GDV calculations? Will it be yield based? Will it be based on average cost or value of a bedroom in the area? So taking into account Article 4 area, taking into account any other restrictions where you are high demand, like a key employers in the area. So all of that is super important. And it's also a good idea for a whole new episode to just show you how to calculate the GDV of your property. And just watch out. That might just happen in the next weeks and months to come. Thank you very much. Oh, this was very intensive, and I hope you got some knowledge from it. I hope you have have taken some notes from this episode, and thank you for being here with me. Thank you for all of your likes, for your comments, and go out there, crunch your deals, crunch your numbers, and make success. And I'm rooting for you and for your next investment to be even better than your last one. So once again, thank you for being here with me on Sunday morning, and I wish you every success, and stay tuned for more tips, more updates to run your business, to invest in properties, and to invest in yourself, because that would be the number one advice I would give you every time I can. Invest in you. You will get the best ROI ever. Take care. Thank you so much. And see you next week on